Background of the short case. So Dimitri Company, a manufacturer of small tools, is assessing its inventory, accounts payable, and net sales balances as of December 31, 2025. The company identified discrepancies in transactions that may necessitate adjustments to these balances due to timing differences, recognition criteria, and potential errors in physical count or invoice recording. 8 separate scenarios were provided for evaluation and adjustment. The main issues are: first one is accuracy of inventory valuation as of year-end due to timing differences. Second is proper recognition of accounts payable, especially with goods received and invoiced at year-end. Third is correct net sales reporting, considering returns and FOB sales. Fourth one is compliance with IFRS standards, especially with IAS 2 inventories and IAS 10 events after the reporting period. Last issue is risk of misstatement in financial reports and potential ethical issues in not reporting accurate inventory or liabilities.
Dimitri Company provided the following accounting information for the year end December 31, 2025. Additional information number 1. We have here tools included in the physical count and billed to a customer FOB shipping point. The shipment was on Dimitri's loading dock waiting to be picked up by the common carrier. So there was no sale made yet. The company still owns this because it was to be shipped FOB shipping point and it was still not yet shipped. So the entry to be made is debit sales, credit. Additional information number 2. Goods were in transit from a vendor to Dimitri and the goods were shipped FOB shipping point. So it was already shipped. We need to debit inventory and credit accounts payable. Additional information number 3. Work in process inventory costing 300,000 was sent to an outside processor for plating on December 30, 2025. So this was not physically counted, but we don't need to have an entry for this. So we'll simply add 300,000 to inventory because it was not physically counted because it was not physically there. Additional information number 4. Tools returned by customers and held pending inspection in the returned goods area on December 31, 2025 were not included in the physical count. On January 8, 2026, the tools costing 320,000 were inspected and returned to inventory. Credit memos totaling 470,000 were issued to the customers on the same date. So we'll be adding 320,000 back to inventory and reducing 470,000 to sales as this was a sale return. Even though the credit memos were issued in January, the return happened in December.
Under FOB destination, the ownership stays with the seller Dimitri until the buyer receives the goods. So as of December 31, the inventory still belongs to the owner. Hence, it should remain in the ending inventory count. Standards and principles involved is the matching principle. In summary, goods were physically received on December 31, but were recorded in January. Even if the paperwork was late, the economic event, the receipt of inventory, happened in December 31. The inventory should be included in year-end balances. Standards and principles involved is the accrual principle and faithful representation. Goods were received and included in the inventory count, but the invoice wasn't added to the accounts payable due to a missing document. The liability exists just because the invoice wasn't processed doesn't mean Dimitri doesn't own the money. The payable needs to be recognized. Accounting standards and principles involved are the accrual accounting and faithful representation. A freight charge for December purchases was billed on January 3, 2026. Half of the related inventory was still on hand. Freight in is a cost of acquiring inventory. Even if billed later, it should be capitalized as part of the inventory. Standards and principles involved is the accrual principle and matching principle.
I will explain the accounting treatment of inventories under Pass 2. First, let's take a look at the nature of inventories. Inventories are as assets held for sale in the ordinary course of business, in the process of production for such sale, or in the form of materials and supplies to be used in production or service delivery. Examples include raw materials, work in process, and finished goods. For recognition, inventories must meet two criteria. First, future economic benefits are expected to flow to the entity and the cost can be measured reliably. When it comes to initial measurement, inventories are recorded at cost, which includes purchase cost, conversion cost, and other direct costs to bring them to their present location and condition. Costs like abnormal waste, unrelated storage, and selling expenses are excluded. Subsequently, inventories are measured at the lower of cost and net realizable value or NRV. NRV is an estimated selling price less any cost needed to complete and sell the item. If NRV falls below cost, a write-down is required, and under certain conditions, that write-down can be reversed. To summarize, Pass 2 ensures that inventories are measured conservatively, providing a true and fair view of the entity's financial position.
Initial amounts of inventory 15,200,000. Initial amounts of accounts payable 12 million. Initial amounts of net sales 81,500,000. Total adjustments of inventory 1,950,000. Total adjustments of accounts payable 1,400,000. Total adjustments of net sales 870,000. This leads to an adjusted amount of inventory of 17,150,000, adjusted amount of accounts payable of 13,400,000, and adjusted amount of net sales 80,630,000. Conclusion: the inventory was understated by 1,950,000. Several owned items were either excluded from the physical count or incorrectly included, resulting in a material understatement of ending inventory. Accounts payable was understated by 1,400,000. Certain liabilities for received or in-transit goods and unpaid freight were not recorded, which would lead to misstated liabilities and misrepresented working capital. Net sales were overstated by 870,000. There were a couple of timing issues with revenue recognition, specifically sales that were recorded before they should have been and customer returns not processed in time. Recommendations: tighten up year-end procedures. Dimitri Company should strengthen its cut-off processes, especially around year-end. This means clearly identifying what goods are owned, which sales are finalized, and making sure returns are accounted for properly before closing the books. Improve inventory tracking. The company needs a better system to capture all inventory locations, including items in transit or with outside vendors. Return goods and work in process should also be a part of the inventory count to avoid missed items. Make sure liabilities are fully captured. Implement a system to flag any goods received or freight costs incurred that haven't yet been invoiced. This ensures accounts payable reflects the true amount owed and avoids underreporting expenses. Thank you.